Most people think hedge funds are just groups of investors trying to pick winning stocks, but many of the biggest hedge funds make money in completely different ways. When people hear investing, they usually imagine someone studying companies and buying shares. That's only one small piece of the hedge fund world. A hedge fund is simply a pool of money managed by professionals. Their job is to find opportunities to generate returns while controlling risk. And here's where things get interesting. Hedge funds use many different strategies, each designed to profit from specific market situations. Let's start with a long position. This is the traditional approach. Buy an asset because you believe its value will rise over time. But hedge funds can also take short positions. That means they profit when an asset falls in price instead of rising. Combine those two ideas, and you get a long-short strategy. Managers buy assets they like and short assets they dislike. The goal isn't to predict the entire market. It's to identify winners and losers more accurately than competitors. Another popular strategy is called arbitrage. This involves spotting tiny price differences for essentially the same asset. If something is cheaper in one market and more expensive in another, a hedge fund may buy low and sell high almost immediately. Now, let's enter the world of quantitative trading. Here, computers and mathematical models do much of the decision-making. These algorithms analyze huge amounts of data, far faster than any human could. They search for patterns that may predict future price movements. Some hedge funds try to remain market neutral. Their goal is to reduce exposure to broad market swings. If the market goes up or down, they aim to make money from the difference between their positions rather than the overall direction. Hedge funds often use leverage. In simple terms, they borrow money to increase the size of their investments. Leverage can amplify profits, but it also amplifies losses. That's why it must be used carefully. Risk management is one of the most important jobs inside a hedge fund. Protecting capital is just as important as making profits. Managers spread investments across different assets and strategies. This diversification helps reduce the impact of any single mistake. The most successful hedge funds aren't relying on one magic trick. They combine data, strategy, discipline, and risk control. So the next time you hear about hedge funds, remember this. Many aren't simply stock pickers. They're sophisticated businesses built around finding and managing opportunities in many different ways. If you're enjoying this breakdown and want more simple explanations of investing, money, and how Wall Street really works, hit the like button and subscribe to the channel. It helps the channel grow and lets us create more content like this for you.